Hello, this is Jeff Hildebrand for TBL Traders. Today's video will be a quick and dirty on volatility analysis. I'm going to point out a few of the important points about volatility and how to look at volatility very superficially. It's an extremely complex subject. Be aware that it plays an important role in the pricing of options, which means that you should look at volatility primarily, or not primarily, for two reasons. One, either it's part of your strategy, or two, because you're looking for good entry and exit points, probably both. Be aware that volatility behaves very differently by product. It behaves differently whether it's in the money, at the money, or out of the money. Usually in the money or at the money options and volatility is higher than out of the money or in the money option strikes. That's called and as a subset of that, there's skew, where the difference between the call and put. I'll talk about that in a second. Finding good tools to evaluate volatility is very hard. It's something that you'll do manually often. It's something you'll get a feel for as well. And I do have one product recommendation if you can pay for a utility. Sorry about that, I'm back. I have one product recommendation quickly because this does a lot of the work for you. It's called LiveVol Pro. It's a very good product. It's relatively expensive, but this LiveVol Pro here gives you good access to historical implied volatility and skew charts, and it's a great option tool. Anyways, that's my plug for LiveVol Pro. I like it a lot. I'm not going to show you how it works here, but it's a good product to buy or to use if you can. So finding good tools is hard. That's one of them. Be aware that volatility behaves people expect it to behave in a certain way. They expect when the market rises that volatility will fall. That is not always the case. I can't tell you exactly what percentage. It depends on the product, it depends on the strike, it depends on a lot of factors. But in the S&P, there's an example here. You can see that's true. The market's been rising since April here, where we had, when you see when the market falls relatively quickly, volatility increases really quickly. When the market rises in a channel or slowly, volatility will decrease. People are less and less afraid. You've heard of the VIX. The VIX represents the S&P, the volatility of the S&P. So you can look at the VIX directly if you want to get a feel for that. On the other hand, individual stocks, I've been looking at Netflix a lot for these videos. Netflix, for example, doesn't necessarily behave like that. It's a lot choppier. It's true here for a period that's rising and the volatility is falling, but as you look at shorter time frames, they're much less consistent individual stocks. Why? Because earnings, there's other events that happen individually, so trading volatility on individual stocks is riskier than trading volatility on an index like the S&P. That's my 2 cents. One other tool that I like, and I want you to see literally what happens and how volatility affects price. So we were looking at Netflix. Let's take the at the money 430, and let's just adjust the volatility, just hypothetically. Let's say volatility goes to 25. Keep an eye on the value of the call and the put at 25, $12. Let's say the volatility goes up to 45. Goes up to 22, the call and the put. So volatility has a direct and profound impact on pricing options. Be aware of this for your entry and exit. Have a look at historical volatility compared to the implied volatility on a daily basis when you're looking at your entries and exits. You'll find with experience that sometimes the more early in the morning and late in the trading day, volatility increases. But as volatility decreases, during the day, your pricing for options will get better. Theoretically, and based on the model, the option price at the strike should be the same. It's not. There's a reason that it's not. It's because the volatility of this particular product, the call, is greater. There's more buying and selling going on for the call than the put, and that means the volatility will be, or the price of the option will be a little bit higher. That difference between these two is called the skew. Now, that's one type of skew anyways, and some traders are able to look at the skew at different strikes, at different expirations, and make trades based on the differences in the skew. Skew is basically a divergence. That's a complicated subject again, but it's part of the volatility pricing model, and you can dig into it if it interests you. Another important thing to keep in mind about volatility and how to use it or be aware of it while you're trading is that let me show you. Maybe I can show you on the calculator. As you approach expiration, let's say there's 5 days to expiration. Look what happens to the option value. Volatility hasn't changed. You see that's time value, and that's decay, if you will. But what will happen is, as you change the volatility close to expiration, as a percentage, you get a greater impact. So close to expiration, volatility will have a greater impact on your at-the-money strikes. So have a look at 2 or 3 things as you dig into this. Be aware first that indexes and stocks, volatility behaves very differently. That's the first point. Be aware that volatility at the expiration is dangerous. So depending on your strategy, closer you get to expiration, the more impact volatility will have on your pricing, on your option pricing. So be aware of that as you apply strategies. Be aware of your approach to expiration. What else can I tell you quickly? Obviously, whether you're selling volatility or buying volatility, it will depend on, like I said, as you get close to expiration. Be aware the products are different. I mentioned that. Keep in mind that there are products on the market to buy to look at volatility specifically, and be aware how your trading utilities your trading platform uses volatility, because it's not completely obvious. Trader Workstation uses the yearly for the historical volatility and the implied volatility. That's why these numbers are very different than this number. Down here you see 4, 5, 6, 7, 8. Calculation is using different things to calculate volatility. So understand how your trading platform calculates historical and implied volatility. Be aware of change in volatility, particularly over the course of the day if you're looking for entries and exits. Be aware of where the pricing is relative to historic. So if today's volatility is higher or lower than historic volatility. And again, be aware of how volatility affects your option price. That's really all I have the time to dig into. It's a complex subject, but if you have any questions, let me know. Thanks.